Hello and welcome back to Market Shares. I'm your host, Tony Blodgett, and I thought today I would talk a little bit about the Fed meeting that we had last week, a little update on interest rates, the market, what's going on, and some of my other thoughts around the topic and kind of what we're going to see in the mortgage industry as we move through 2024, just based on what we're seeing here in the first month of the year. So I got to tell you, I was really, and I think a lot of people were kind of waited with bated breath as far as what Jerome Powell was going to say at this Fed meeting. You know, there really wasn't any anticipation that they would be lowering the Fed funds rate. But if you remember at the previous meeting, he was very dovish. And really, we talked about, how there was almost a pretty significant pivot in the stance that the Fed was taking regarding interest rates. They basically committed to the fact that they would be lowering interest rates in 2024. And as a result, the market really rallied. We saw rates get a lot better. Mortgage interest rates got better. And the bond market really rallied around that news. And so, since then, there's been some other Fed members that have come out, some other commentary that are really almost felt like they were trying to walk back a little bit, what Jerome Powell had said and, just say, hey, look, inflation's still a little bit sticky. I think I talked about in a previous episode, the Fed is, anticipating 3 rate cuts. The market is anticipating anywhere from 6 to 7 rate cuts in 2024. So I was nervous that he was going to try to kind of walk back some of his very dovish comments that he made at the previous meeting. And so I was watching it very closely. And, he didn't really do that, which was good news for us. Now, what he did say was that just that, inflation is still pretty sticky. We have not finished the job yet, meaning the Fed has not finished their job of lowering inflation down to their target, or really that they feel like easing up right now is going to allow them to hit their target rate of 2% for inflation. And so he did reaffirm that. The market did not love his comments. It was not really bad. There wasn't a massive sell-off, but I think that day the bond market, mortgage-backed securities were off by about 40 basis points on Friday, followed by another 30 basis point runoff on Monday. And so, wasn't great. We did see rates get worse. Matter of fact, we've seen interest rates get worse really since the end of December. I mean, December 27th was about the peak of what we saw in the bond market. And then from there, they, continually have gotten worse as we moved into 2024. And honestly, that's not a huge surprise. We did expect that although interest rates are still widely anticipated to improve throughout 2024, like we said, it's going to be volatile. It's going to be a little bit choppy. And this is one of those pullbacks right now. But I think that it's important to point out what we saw with housing. And we've talked about this as well on previous episodes, how as soon as rates came down at the end of 2023, like I said, reaching their peak there at the end of December, man, we were seeing multiple offers already. So we've already seen a glimpse of what's going to happen when interest rates really start to improve. They have eased back a little bit. Rates have gone up a little bit as we moved into February. But you guys, I think if you're a mortgage person or in the real estate industry, you have to be advising your clients that now is still a phenomenal time because it's only going to get worse as the year goes on and rates get better. Now, I thought it was also interesting that Jerome Powell was on 60 Minutes on Sunday. Now, that was recorded on Thursday, right after, I'm assuming it was right after the Fed minutes and discussion. So nothing new there. I did watch both the live release of the Fed minutes, and then I also watched the episode on 60 Minutes. And not a huge, nothing earth shattering, no differences really. He's very on point with his comments. But what it tells me is that when the Fed governor or the Fed president, Fed chairman is on 60 Minutes, that tells you that this is a topic that everyone in the country is interested in and is watching. So, it's kind of like the mortgage industry, the real estate industry is right now the most impacted, it appears. Matter of fact, he even said that. We have not seen consumer spending really cool down. There hasn't been any huge negative impacts on employment, but things like mortgages have gone to, almost a screeching halt as a result of interest rates being high and the monetary policy that the Fed has. And he acknowledged that, So anyway, that was interesting that he was on 60 Minutes. It's very mainstream right now to talk about what the Fed is saying, and everyone is watching. Now, he did pretty much in the comments section at the end, he was asked directly, essentially, if they were going to lower interest rates in March. There are a number of people that are predicting March. I think most likely May or June is going to be when we see the first rate cut. But he was asked directly about March, and he basically said, I highly doubt that there will be enough evidence in 7 weeks or 6 weeks from now to justify a rate cut at that time. So, he basically said we're not going to cut rates in March. And I think everyone's kind of looking at that May, June timeframe on when they're going to lower rates. Now, I've looked at a lot of economic information, you guys, and here's the thing is once the Fed starts, historically, they move very quickly. So I still think even though it might be March might be May or June until the Fed does their first cut, I still think we could see those 6 rate cuts based on historical actions by the Fed. Once they start moving, they tend to move rather quickly. So I think we're going to see some volatility between now and then. And I think that it may have opened up a window here for first-time home buyers and people looking to move up to get out into the market, get pre-approved, and go look at homes before we're back to multiple offers when things really heat up here at the end of spring into the summer market. So that would be my thoughts there, you guys. I was hoping to do this episode and have some, really spicy things to say about the Fed's comments, but there wasn't a lot there. I was just happy that he didn't completely walk back his dovish stance and really, put the market into a bit of turmoil, which he did not. Now, the next couple things I want to talk about is also around interest rates. You guys, we are seeing significant pricing pressure in the mortgage industry. And this is really no surprise, right? It's just your typical supply and demand situation. There's not a lot of mortgages out there being originated. And so everyone is fighting for those loans. And what happens when there's that much competition for the businesses out there? Well, people lower their margins to attract in that business. And so what we're seeing right now is a lot of mortgage companies are looking at ways of lowering their margin. And there's only a few ways to do this. One is obviously focus on cutting your costs. And we've been doing that as an industry for the last 18 months. You've seen a lot of layoffs in our industry. You've seen a lot of other cost cutting measures that have been taken. And so that is continuing here as we move into 2024. The other things that you can do is you can put pressure on compensation, right? The number one expense that comes out of the margin of a loan is the loan officer's compensation. So we're seeing that being squeezed down. And some of it's on the part of companies pushing down loan officer comp, but we're also seeing loan officers volunteering to lower their compensation in order to get more competitive pricing on the transactions that they originate. So you're seeing people who might have been at a 125, 130 basis point comp plan opting for a 100 basis point comp plan. I've even seen quite a few that are opting for things in the 80 to 90 basis points. So kind of voluntarily lowering compensation on all of their transactions in order to get a more aggressive rate sheet to offer their clients and hopefully attract and retain more of that business. We're definitely seeing competition on the bank and credit union side. And, it's a little different when you think about banks and credit unions because, especially local banks, right? Regional banks, things of that nature. A lot of these banks and credit unions are originating loans that they're going to hold themselves. They're going to use their own portfolio of funds to fund those loans. And so they have the benefit of not having to deal with the secondary market. And what we see right now is that many of them are willing to offer an interest rate that's much lower than what's available in the secondary market. So what we see right now is a lot of them that are willing to offer interest rates that are much lower than what's available in the secondary market. And if you think about it, it kind of makes sense, right? So if I'm a bank and I'm taking in my customers' deposits, or I have money in their savings accounts and I'm paying them out Although money markets are paying, in the fours, maybe as high as 5%, most checking and savings accounts are still only paying, less than 1%, or maybe it's 1% or 2%. So if that's your cost of funds and you're able to then lend those, that money out at 5.5, 5.75, 6% interest rate, well, you're still making, a very good arbitrage on those funds, and you're going to be retaining them in your servicing portfolio and retaining them using the bank's deposits. So you're not as concerned about what the value of that might be, say for a Fannie Mae, MBS, or whatever the case may be. So, this is difficult for loan officers that are in markets that are very heavy with local banks and credit unions, because we definitely see them, kind of undercutting the market. Now, here's what I find with this. Couple things. One, generally speaking, their loan officers are not making nearly the amount of compensation that a traditional retail originator would make at an independent mortgage banking company. So that's one thing. Two, these tend to kind of come in and out of the market. So if you think about a bank, they have to deploy their assets that they have. If they're have deposits on hand, they have to lend that out and make up for what they're paying out in interest. And so they don't really have a choice but to deploy that. And as I mentioned, there's a lot less options out there to deploy that. So lowering the interest rate is really their only way to bring in that volume, but it does tend to be cyclical. We don't typically see this happen for a very long period of time, but I would definitely say if you're an originator out there, you know exactly what I'm talking about. There's a few banks and credit unions that are just really undercutting the market, and is creating a challenge to compete. But just know that what you typically find is these banks are not very advice driven. So really focusing on working with your clients on a strategy for helping them buy their home loan, talking to them about different products and programs that are going to benefit them, bringing value to that relationship. That's where you're going to win against the banks and the credit unions, in my opinion and in my experience. But look, at the end of the day, some clients are only going to focus on interest rate. They're going to shop around until they find the very best rate, especially in an environment like this where rates are still on the higher side. And so that leads me to my next point, which is that pull through is some of the lowest that I've ever seen. And I've talked to a lot of people in our industry. I have a lot of friends that are at an executive level at other mortgage companies. And I'm hearing that, pull through numbers are some of the lowest that we've ever seen. And what I mean by that is, people get a lead, they get an application, and the amount of those that are turning into fundings is pretty low due to interest rate pressure and interest rate, clients shopping around for better interest rates, because someone's always willing to do it for a little bit less. And so I know it's difficult, but to the extent that you can, shifting that conversation away from just the interest rate. Obviously, the interest rate is an important component to the overall transaction, but there's a lot of other things that can be valuable to your client, and we need to make sure that we're emphasizing those things. I've heard pull through, or fallout numbers of, as high as 70% of the leads that they're getting, they're losing to competitors for interest rate. And so I say that because hopefully as an originator, if you're watching this, it's a little bit reassuring that everyone in our industry is dealing with this pressure. It used to be maybe that if you got 10 leads and they were strong referrals from a great referral partner, you could expect, 8 of the 10 to go with you, an 80% pull through. And right now, I think that number could be as much as 50%, or in some cases, maybe only 30%. And so although that's frustrating, what it tells us is that we need to increase the amount of leads that we're getting. And don't be so hard on yourself. Obviously look at your process, how it is that you're advising your clients. But if you're losing more than you used to, that does seem to be pretty normal for what's going on in the market. And I'm curious if that's what you guys are seeing. Feel free to leave a comment below if you're seeing numbers like that. Maybe you're not seeing numbers like that. We would love to hear some feedback on what it is that you're doing in this highly competitive market in order to retain more of your customers. So I just wanted to touch on that. And the last thing is, man, we are seeing a lot of M&A happen, mergers and acquisitions happen in the mortgage industry. And I don't think that it's going to slow down anytime soon. As we quickly are approaching, or we will be approaching the end of the first quarter, and we start seeing companies that have to pull out their financial year-end numbers for 2023, I think we're going to see more and more mortgage companies, especially, small or mid-sized mortgage companies that are just not able to continue with all of these pressures that I've been talking about. All of it impacts us. And so we're definitely seeing mergers and acquisitions. There's a lot of movement going around in the mortgage industry in this fashion. And some of those go very well. Some of them creates fallout. So if you're a manager, if you're someone who's looking to recruit and grow, I think it's still an opportune time to do that with the disruption that's happening. And even if there's not M&A happening, right? So there might be mortgage companies that are really feeling the pinch from all of these pressures that are against them. And as a result, maybe they don't sell their company or they don't, merge with another company, but maybe they're putting in place significant changes as to how it is that they run their daily business. Maybe they are looking at changing compensation plans. They're, laying people off. I've seen a lot of people at the regional level, divisionals, some of these management roles that some companies might feel are, they're expensive roles, they're non-producing. And so some people are, removing those sorts of layers from their entities. And the reality is those people have a lot of relationships typically because they mentor, they coach, and they recruit people to their team. And so when they get let go, it causes disruption. So there's a lot of that going on. And you guys, I just don't think it's going to slow down anytime soon unless we see a significant shift in overall transactions and profitability. And, we're just not expecting that in 2024. It's going to be a better year. There's no question about that. We are going to see lower interest rates, but I don't think we see a massive swing in things. So it's going to continue to be a bit of a grind out there, but there are opportunities. Whenever there's difficulty and challenges, it means there's also opportunities. And I would look for those if you're looking to grow and, team up with great loan originators. There's going to be some displaced people out there as we move forward. So that would be kind of my take on currently what's going on here in February of 2024. I'm going to continue to do some of these market updates because I think that it's very relevant. I think people are closely watching what's going on. I wish I had more exciting news about what the Fed said, but we're going to have to wait a little bit. It'll be very interesting what they say in March. I don't think they're going to cut rates, but are they going to firmly indicate that a rate cut is coming at the next meeting? I wouldn't be surprised to see them kind of tip their hat in that direction. And I think everyone will be watching very closely to see what happens. And the last thought I'll leave you with is what I mentioned earlier. We have a window of time right now. We saw what happened when rates dropped quickly at the end of 23 and how things heated up. You guys, there's a moment in time right now between now and probably May, June, when we definitely have an opportunity to get our clients out looking for homes without as much competition as I fear we're going to have as we move into the later part of the year. So take that away and do with it what you will. And I sure appreciate you guys taking the time to watch Market Shares every week. For those of you that are already subscribers, thank you for your commitment to what we're doing here. And tell someone about Market Shares if you would. We want to grow our subscriber base. And also, if you don't have time to go on YouTube and watch this, as many of you do, we are available on all typical podcast platforms. Check us out at Market Shares or go to marketshares.com. Thank you so much and have a great day.